Property Investing Insights, your authority on all things property investing, finance and wealth creation with Right Property Group.
G'day, how you going? Phil Tarrant, co-host of Property Investing Insights with the Right Property Group, and I was just listening to the intro there, and I often just listen to the guitar riff, but I listen to the words there and actually spoke about finance, and finance obviously being critical to the whole journey of property investing. So I really want to focus on today because it is a complex and complicated finance market at the moment. Most investors I know are having to be quite nimble in order to ensure that they can continue to access finance. And for many of them, it means not necessarily investing in their own names and doing it through some more sophisticated structures. We're going to get into that today. Finance is the enabler of growing your portfolio. Joining me in the studio, Reshmi and Victor Kumar from Right Property Group. Welcome back, guys.
Hello.
Hello. Hello. What's been happening? Much? It feels like we're just together.
Yeah, it feels like that because we did the last podcast a bit late because I think I was sick.
You were crook.
Yep. Yeah. And then you were busy with your pina coladas.
Yes, I was. Yeah, I was. The cocktail hour sort of extended over a week, but no, it's good. But how long have we been doing this now? It's got to be seventh year.
So I was just talking to the guys outside that do all the grunt work in the background, and you just become the showpiece.
Is that right?
And we were talking about how we first started off, and this was pretty much one of the first property-related podcasts out there, apart from one or two others.
Yeah, pioneers.
Pioneers.
We're actually really pioneer. You're probably one of the first buyers agents to actually have a dedicated sort of knowledge-based podcast for the purpose of educating and informing listeners, right? And it's been a great enabler for reaching more people. I know last time we got together, you said you're kicking off back into gear, and I'm going to get the name of it wrong.
Right on track.
Right on track.
Yeah, yes.
I was going to say right track, right on track.
Yep.
Any more news around that? What do you got for us?
Well, when is it? September is the third is the date here. Yeah.
Wow.
Venue still to be confirmed.
TBC.
I mean, interesting enough, venues are hard to find at the moment. Good venues. Yeah. It's a lot of people doing events, right? And I think we've seen it. Like Momentum, which is sort of part of smart property investment. All the stuff that we do here is probably one of the larger event companies in Australia for business events. And it's tough, right? People want to get together face to face. I can see why you're doing this again. The podcast has been great for communicating and educating your client base and for those people who are sort of interested in it. But no doubt you're looking forward to sort of getting in front of people again and face to face with a cup of lukewarm tea and a biscuit. And what's 3rd of September? Yep.
Any idea what the topic's going to be yet, or is it going to be sort of back into it?
I can tell you one thing: it's going to be about property.
Really?
Yeah.
Not about finance.
No.
Is property and finance one and the same, Reshmi? Can you do one without the other?
Definitely not. Well, finance is the key part of building a portfolio. So if you have to get the finance right, like if you want to have a good portfolio, finance is the key. So
it is. I think you've always said it's a game of finance.
Yeah, it is. Yeah, pretty much. Yeah, it's property is just the vehicle, right? And until you've got the fuel in the tank, which is finance, you can't go anywhere.
How many people sort of come and see you guys at Right Property Group and say, I'd like to buy sort of 4 or 5 properties and I've got cash. Does that happen?
It does happen.
Yeah?
Yeah, it does happen. And my first comment to them is, well, why don't you get the leverage while you can and preserve your capital and you can put the money into the offset and have relatively the same impact as if you're buying cash. And you've still got the full access to the capital, right? Because generally, there are a few archaic rules that people get caught out on when they're buying cash. One is the cash out policy with most banks. They have a cap in terms of how much you can pull out of the property when it's owned unencumbered. Some banks would be 50,000, other banks would be 150, unless you can show a direct nexus to another purchase or another purpose. They won't give you that big cash out.
So if you put all your money in, it's getting a bit tactical, but
straight off the bat,
if you buy someone in cash and then say, oh, you know what, I want to access some of that capital, they're going to, and therefore you need to put a loan against that property. They're going to go, we're only going to give you so much.
Yeah, what's the purpose for the money?
Yeah. Okay. Yeah. And there it sort of gives a sense for the sophistication of finance as the fuel for driving sort of real estate transactions and your property portfolio. You spoke there, Victor, around terms like leverage, around capital preservation. So I really want to deep dive into finance today. You've always played the game pretty well in terms of finance.
One would hope so.
Yeah.
Knowing where he's come from.
And this is, finance is connected in with cash flow. Cash flow is connected with the performance of your property. It gets all quite complex, but I guess the secret is being able to simplify it as much as possible. Does your client base largely sort of have a comfortable relationship with debt as a tool and utility?
They go through different hiatus, just like we have, right? So initially you get scared you become very gung-ho and you start saying, you know what, I'll go buy the best property out there. I'll spend $1 million or I'll spend 500. Then when the property lands in front of you, then you realize you have that choking moment of saying, oh, hang on, I didn't realize that this was going to cost me to hold and it's going to impact lifestyle. And then you become very complacent with debt as it comes into the portfolio, because you realize, hang on, it actually wasn't a life-changing moment, right? It just happened in the background. And then from there, you start getting more and more loans as you're building the portfolio. And then you hit another choking point where you sort of realize, hang on, I actually owe 5 million or I actually owe 2 million, depending on what your thermostat is. And you start to scale down to say, rather than buying a $600K property, I'm going to buy, say, a $400,000 property. And we were discussing the car as to the difference between the 600 and the 400 as an example. Yeah. So often you find that you go through this journey in terms of finance where you feel that you've got it under control. Then you start having those sleepless nights and start looking at, the amount that you're owing to the bank, and then all of a sudden realize that it's actually not that bad, or depending on how you structured it, this is dire straits, I need to do something.
Yeah, and your relationship with money and your relationship with debt changes as you sort of become more experienced. And Reshmi, you must, your relationship with money's probably changed a lot over the years.
I think it definitely has. Growing up, we had cash flow at home. Like there was my father had the business, so we had cash coming in, and there was poor management. I could see as a child poor management of that money, and I think anything to do with money comes back down to what the relationship you have with money comes back down from your childhood. And as we have grown with our portfolio, I've seen how my thinking has changed, because there was definitely a time that we were trying to save as much as possible and invest, and then the decisions we made in some of those times was like, okay, let's not buy this property because we don't have this extra money to do that renovation. And that's the time when we didn't really know where we would get that money from. But as we have progressed, yes, the thinking has changed, because we know now what we could do in order to create some money or get some money out from one of the properties or something else, and be able to do what we need to do with a particular property to grow the portfolio. So things have changed, and I must say, spending money was not a habit of mine. And it was very difficult for me.
Thank God.
It was very difficult for me to get used to spending money.
Yeah. I still struggle with it.
Yeah.
I seem to spend it, but I still have it's funny how you say your relationship with money really starts from your sort of childhood, and your attitude to money can be a great enabler, but your attitude to money can always be a great inhibitor as well.
Absolutely.
And you must see it in a lot of financial coaching around this idea of debt, particularly, and you see now culturally, it could be where you're sort of the origins of your culture, where you're from. Certain cultures have different attitudes towards money. If you think about the classic mindset in Australia has always been, buy a home, pay it off, right? And generational changes or attitudes towards money. But it's hard to shift that mindset. I still don't like paying for stuff.
Yeah,
you know?
we've come across quite a few people who don't want to have a lot of debt. People don't buy homes or buy investment properties because they don't want to have that debt. And one day, I mean, if they realize that the proper use of money, the way you use money, you can actually educate yourself how to use it properly so you can make a good use out of that debt. So it helps. The knowledge you need, the knowledge people need to have regarding property, regarding money, a good knowledge about how to use that money really is very helpful.
It changes the education system, right? Because we're not taught in schools how to manage money, right? And this is, if there's anyone that's working on curriculums, they should really include in schools how to manage household budgets, not fluffy stuff, but real brass tack stuff.
Yeah, and the issue you have today, and you see social media posts of people sort of not understanding what a credit card is, right?
Mm-hmm.
Going, I spent all this money, what, I've got to pay it back. Like, I don't really understand it. A lot of, it's generalising, but there's this expectation that your children learn about money at school. Education around the foundations of money education need to start at home.
Yep.
Absolutely need to start at home. That said, not everyone's sophistication around money management is great. Mm-hmm. You know, a lot of adults find themselves in financial trouble, and it's just the basics of good and bad debt. You know, what we're talking about is good debt connected in with appreciating assets. Spending money on which you can't repay on credit cards and you know, car loans and family holidays you shouldn't be affording. It's very, very difficult, and I'm going to say a lot of people still get it really wrong. You must see it all the time when you're chatting with people around sort of planning for a financial future, when, you know, the first couple of years is probably fixing people's problems.
It is, and also getting them used to carrying larger debt, right? And one of the things that I notice is that the higher your income, the more extra spending you do, and the less management you have of the money, right? But the less the income, within reason, you tend to get more focused to utilize it because you're at a pain point, right? Whereas the higher income earners aren't necessarily at a pain point. The analogy being that if you're middle class, you don't have enough discomfort in life to strive for more, right? Because you're cruising. So there is that generalization there. But certainly I'm still also seeing every now and then the thought process of, okay, I want to knuckle down, pay off my home first, then I'm going to come back and invest, right? So, and this is again, to your point, not actually understanding how money works and how you can make it a really good, useful enabler and a good tool rather than a really bad master.
So what's the secrets then, Reshmi, on what do you got to get right when it comes to finance and what do you really got to avoid, if you're going to summarise that?
Oh, gosh. Well, I think... again, generalizing, what I come across is a lot of people are more into the materialistic side of things. I want this, I want that, rather than really focusing as to what it is that's going to give them a good lifestyle. Being happy right now with the money you have, that's what one thing people need to really look at. Is this something I really need right now? Or do I need to do something with my money, better with my money, so I have a better lifestyle in the future when, let's say, when I'm not able to earn or my super is not enough to give me the lifestyle I want. What I have right now to maintain the same lifestyle, do I have enough? So a real hard look at what we have right now and how we're spending our money right now. That's where it needs to start from. And
so knowing the baseline first before we do anything. Yeah.
So when you get in front of clients, you know, again, generalising, but how many of them would have a detailed budget where they know exactly where they are, that gives you confidence to maybe accelerate decision making around property purchasing rather than having to go through the whole unravelling of someone's personal finances?
Yes. So if we went down the pure financial planning model, then they'd have to do stacks and stacks of spreadsheets to know exactly where the bleed is, right? So we then create a life hack there in making sure that we don't have to get stuck in that preparation mode. Rather, we look at what their structure is right now in terms of, let's say they had an owner-occupied mortgage, and we could look at potentially restructuring that to reduce the repayment, to create the ability to hold on to more debt, and then also looking at the comfort level. So if they've been, as an example, been comfortably saving $500 a month, that could become the holding cost before tax for a property, right? Along with a few other tweaks we can make, so that we're not really making any drastic changes immediately to their expenditure pattern. Of course, if you're having Uber Eats every night and then you're spending beyond your income earning capability, then investing should be the second thing you do. You need to fix the baseline first. But a lot of this, as the portfolio unfolds, as we sit down and do the reviews, we are giving subtle pushes and subtle hints to start that goal-focused spending and saving, so that we are then able to still have. See, I'm a big believer that investing should be happening in the background. Lifestyle should be happening in the forefront, right? When we started, we did it the opposite way, where we were all about investing and lifestyle.
But you might need to do that for a period of time.
You could, you would, right? If you've got nothing to show for your efforts still to date, you may have to cut back a bit in terms of expenditure. But that doesn't mean compromising on everything. Drilling down to not having a Netflix subscription. If you're down to that level, really, you need to fix the base first before you start investing.
And when you're sort of doing planning around property purchasing with a view towards finance, and this sort of do's and don'ts, I guess, how much does it try and identify additional capacity people have in order to accelerate property investment decision making? Is that the key? Like, what's the bit that's left over, and how much do we want to use of that?
Absolutely, it is very much the key to have that number down pat in terms of what's the red line impact, right? So we've got two red lines now. So one would be the personal, which is where comfortably from your household budget how much you can set aside to hold onto your portfolio, and then the slush fund that you've got or the buffer. The other is the red line that the bank automatically gives you, right? And understanding that the bank puts at the moment 3% buffer on what you're borrowing. So if you're borrowing at 7%, they're assessing a 10% interest rate.
Yeah.
Yep. On a 25-year loan, principal and interest, as opposed to giving a 30-year interest-only loan. And so if the bank's willing to give you 800, know that you are comfortably able to service beyond that 800 in today's dollars, right? So one of the things that people tend to do is, if the bank's willing to give you 800, they say, I've got a pre-approval of 800, but I only want to spend 600. Because we were discussing this along the way, right?
Yeah.
So
thinking that the amount of money that would need to fork out is going to be less, but it doesn't work out for a successful portfolio, I guess. It doesn't work.
Yeah, often they start looking at it from, okay, if I've got an $800,000 loan, they're looking at it from a home loan perspective. So they own occupied mortgage. So I have to come up with the whole repayments. They forget to take into account.
It's a thing called rent.
Yeah, called rent. Yeah. And so that's the key. And that was, for us, that was the aha moment when we started investing, was that, hang on, there's rent coming in. And therefore, I only need to chip in this much to control this debt, right? So, and that's why I keep saying in most podcasts is that don't focus on the dollar amount that you owe. Focus on the dollar amount you need to chip in to control the amount that you owe.
The gap. You got to clear the gap. And when interest rates are higher, often, there's going to have more. If you're still acquiring property, you're probably going to have more negatively geared properties than positively geared properties. And I know within the Right Property Group network, you have a mortgage broking company called Investify by memory. And to the point around property being a game of finance, there's a number of games going on simultaneously, if you want to put it that way. There's how you choose to present your financials from your accountant will be really dependent on what you choose to do in finance. Yeah. What you choose to do in property. And the financials should be the financials. And you need to get them constructed appropriately from an accountant. However, you must see people, self-employed people, coming to see you going, well, I've got heaps of capacity, but then, you know, you look at their financials and say, well, you're not making any profit. They go, well, sort of we are, but we're not. And, you know, a lot of this comes down to the way you present your finances is going to be dependent on how well you can invest in property. You must see it all the time.
All the time. Yeah.
People are trying to save on paying tax. So that doesn't work for when you want to build a portfolio.
Yeah, and this comes back also looking from a financing point of view is what the bank is willing to lend you is going to be based on the information that you've provided to that bank for the purpose of securing the loan. You need to be comfortable with your real spending situation and sort of just going, oh, look, I can cut back on that. Don't worry, everything will be okay. Like, it's not always the way it works, is it?
No, it's not. Yeah, and really importantly, when you're looking at it from, so we're talking about self-employed people, right? It's the understanding that you can't have a tax minimization scheme running parallel to a wealth creation scheme, right? So if you want to create wealth, you need to show income to qualify for finance. In other words, pay some tax.
To pay tax.
Yeah. And so one of the things that I do, and I strongly advocate with a lot of my clients that are self-employed, is sit down with the accountant in April and your broker. So get that meeting happening where the accountant prepares the financials and flicks it across to the broker to say, can you get lending on this? Or do I need to represent the same figures differently, get my client to pay a bit more tax so that we can actually get a few more assets that are in growth phase, rather than let's minimize the tax aggressively and then you find out that you can't actually build your wealth.
Yeah, not all accountants are created equal when it comes to this. In Australia, we're very fortunate. We have a lot of very good, sensible tax practitioners and accountants who are probably quite good at understanding the rules around tax minimisation. However, I've only met a handful of accountants who are really dialed into property, who really get it from a point of view of finance and being finance first as a mechanism for growing a property portfolio. And my accountant always tells me it's a sort of a success fee, right? Like taxes, like if you're paying tax, Phil, something's going right in your life, so pay your tax, be happy about it. I'm happy to pay tax. I think it's important to contribute to the tax system and
just don't
the revenue system. But do it so it doesn't stifle your ability to wealth creation. So what is your point? You can't have a tax minimisation and a wealth creation strategy running in tandem.
That's right.
Yeah, that's probably one of the first realizations for a lot of investors when it comes to invest in property, Reshmi. Do you sort of, does mind boggle sometime for you where you got to just trying to re-educate people on a very different way of thinking?
It is a bit of a barrier there because there has to be that mental shift happening. Okay, is this really possible? Because they have to understand that it is possible. So once you show them that it is possible, then they start to get comfortable with that idea that, yes, I could do this. And they have to kind of take a step back and work their way through. It may take a year or two for them to get back on track and then start, because people may want to get started with investing and knowing their situation the way they have presented their papers. They may have to just hang on a little bit.
So time. Sometimes you may need time to remedy what might have been poor structural planning moving forward. So in terms of the common decisions that you see stunting portfolio growth, I imagine presentation of financials or how you choose to shape your financials will be one of them. What else are you seeing that can slow down growth from a point of view of finance?
Yeah. So when I initially sit down with someone, I ask a few very leading questions, right? So I look at it in terms of, okay, where are you in life and mindset, and who are your advisors, right? And if I hear that, I'm using my accountant, my dad's been using that accountant, it's always been my family accountant, the next question is, okay, do they buy property? Yeah. The accountants buy property. How often do they buy? Are they currently buying, or they bought 20 years ago and they're riding that wave and that bandwagon? Because as you grow, you need to be changing advisors accordingly, right? And then you outgrow your advisors as well. Okay? And the other is, I've always banked with, I'll just pull a name, Westpac, and we've always banked there, so that's how we will roll. We'll go to Westpac, or my home loan is with Westpac, and so I'll go back to them. We're creatures of habit and also creatures of convenience, right? So if they've got most of financials, that's where I'll go. But this is also understanding how debt is regarded by the bank. So if you've got massive debt with one bank, of course you get a discounting and people get attracted to that. But then they're also constrained in how much they can lend to you, because now all of your debt is being buffered at 3% at the bank to get you to qualify. Whereas if you went to a different bank, the scenario could be different, the calculator could be different. At the end of the day, the name of the lender is immaterial, so long as they don't have absolute dire straight conditions. There's now a big shift happening of getting away from the big four and looking at other lenders as well. So it's become now mainstream to buy properties using those lenders' monies, because people are starting to realize that, okay, I'm paying 0.5% more, but I'm getting $200,000 more with that lender. And therefore getting to a bigger asset. And we went through that growth.
There was a time that people were not comfortable using those other lenders. They were only those four that go with. Mm-hmm. And that has changed a lot over the last, let's say, 20 years. We've seen.
I completely agree. And I've been reading a lot of commentary coming out about the increase in volumes to non-bank lenders and second tier and also non-bank lenders. And one of the reasons why, and I caught up with the head of the broker arm of ANZ just the other day, and she said they're doing a lot more. There's a lot more investor loans happening, is what's happening. Yeah. So you're seeing a lot more investor activity out there. However, for a lot of investors, because of the lending conditions and the climate, they might be with one of the major big four banks, and you get to a particular point with them where they say, we're not lending you any more money because we have thresholds, right? Yeah, okay, well, you go to another big four bank and you might be able to use them for a little while. But the non-banks often have policies which may be more supportive for property investors in that their serviceability calculations requirements may differ. So a lot of property investors are turning to the non-banks, which is great for competition.
And the product features are more flexible, I guess. Yeah, that makes it really worthwhile exploring these avenues as well.
Yeah.
Yeah, see, one of the things that people get attracted to is now, their internet banking is really good, so I'll go stick with them, right? And I know it's a bugbear of ours with the lending we've got, that some of the lenders have got really horrible internet banking.
Some of them are pretty bad. Some of them are great.
Yes.
Like the big four largely are pretty good. Some of the non-banks are, it's they don't invest as much money into it, right?
Not in the infrastructure.
Yeah, I don't want to be sitting there and calculating the different mortgages on the different accounts and stuff like that, because the internet banking, like if it's not allowing the naming of the accounts, that's a pain.
You know what's really funny? It gets let's talk about this for a moment, right? Because it's important, but it shouldn't shape it like, I bank with a lot of lenders, you bank with a lot of lenders, right? The difference even between the big four banks, I think of, I bank with Westpac. Westpac is excellent as a property investor if you have multiple structures and stuff, right? St. George, same bank, is absolutely appalling, right? Yeah. Like I've got a list of probably 20 or 30 accounts that you got to try and name and give us some order and stuff, and like these things sort of matter because it makes your life a bit more of a nuisance. However, a dollar is a dollar,
yes.
Right? This to your earlier point, a dollar from Westpac is the same as a dollar from largely St. George is the same as a dollar from Pepper, it's still a dollar and is an enabler.
Yep.
The dollar is an enabler. So, you've got to put up sometimes with administrative frustrations, Reshmi, for the purpose of, I'd rather have good capital growth and a growing portfolio and deal with some hassles from internet banking. Victor doesn't have to worry about it,
I'm the one doing it in the background, but it enables us, it gives us a lot more freedom. So
don't make your decisions on who to bank with based on the internet banking.
No, don't.
We had it going good when, before it was all neat and clean, but at the moment I'm a little bit... Yeah.
A little bit all over.
Because we've got a lot of constructions happening, right? So finance is very haphazard at the moment. I'm taking money from whoever the lender is giving the money, and within reason, whatever interest rate they're charging me, because I need the funds to leverage and do multiple constructions really quickly to be in time for the next swing of cycles in the areas I'm doing the construction.
So you need to get it done so you're ready for the market. See, and this is a lot more sophisticated. This is not like sort of nickel and dime type, meat and potato properties. This is where you're strategically looking at the time, activities in your portfolio for what you're assuming is going to be upside potential. So you're happy to take
a hit. Yeah. So it's the same as like you have to pay tax, right, to get lending. Right, I'm taking the same analogy to say, okay, I'm paying 0.5% more to get access really quickly to the money, or access to more money, or their valuation was far more favourable, or their construction loan was far more favourable.
So that's another big thing with lenders. Your valuations can be, if not tens, hundreds of thousands of dollars of difference depending on who the value is. Again, this is the game. This is the game of finance. And a game is like, you play it well. You got to enjoy the game as well, because a lot of people, you must see it, Reshmi, they just don't want to deal with it. It's the finance bit is a
headache.
Frustration and it's stressful, but you got to play the game.
You have to really know what you are in for. So
I still go through the which I haven't had to do for a little while, but calling up banks to say,
I've stopped doing that because I've hassled them enough for this year.
Yeah. Just saying, hey, look, I want a sharper rate, and they go, no. Yep. So if and when rates start coming down, you're going to have to play the game, and it's frustrating. It's a nightmare, right?
It is
fatiguing and soul destroying.
Yeah, and I also understand that this is where perhaps the trepidation is going with the non-bank lenders. They can be slower to pass on a rate cut than the Big Four. Not always the case.
Yeah.
Or they may not pass the full rate cut when that does happen. But I don't believe we'll have that issue for the next at least 12 months, in my opinion.
Yeah, and this gets to the point of being, again, you would probably say you got to be prepared at all times with your finance. So at a point in time, if rates do come down and your lender's not passing on those rates, I mean, the likely result is you're going to have to refinance. So you've got to be ready to go. So are you always finance ready in your portfolio?
You have to be.
Yeah.
You have to be. We're feeling a little bit behind on things just because of those constructions going on. But that's the thing.
And it's easy to get finance ready if you spend the time, energy and effort in the Reshmi? Sometimes?
It's a lot more involved. It's a lot more involved because I have to prepare a lot of paperwork to give to the broker. But once everything's there, it's smooth sailing. But good record keeping is
Yeah, so let's talk about that, right? So as a portfolio grows bigger, the paperwork becomes a whole lot more onerous, right? And what Reshmi and I have done is that we've centralized all the information. So we put all the statements into Dropbox and then send the link to the broker rather than sending things piecemeal. They go in and they take what they need from that Dropbox. Makes life a whole lot easier. There are some brokers that will actually get you a link where you can dial in your banking, internet banking with most banks, and it'll automatically download the statements for the last 6 months to the broker. Yeah. So there are those electronic ways you can make paperwork a whole lot more easier, but it still comes down to if you're not systemizing things right when your portfolio is small, you're creating a bigger and bigger problem as the portfolio grows.
Yeah, I completely agree with that. And I probably swing from being super prepared to not so prepared, and then something happens where I've got to quickly get more prepared. The ideal sort of baseline setting should be always ready, right? And that just means ongoing maintenance.
Yeah, ongoing. So I'm ready every month. So when Victor needs something, it's always there. I may be behind like 2 weeks, just when the statements are falling and all that, but I'm always ready with all my paperwork. So if it's needed, it's just there.
It's there, and you can move quickly. And it's are you seeing a lot more? And sort of chatting with the ANZ broker head the other day, she's saying things are getting more complex. That's probably the word. Maybe I'm putting words in a map. But it was like, because of serviceability these days, property investors in particular, this is my view now, is they're having to do things differently in order to maintain ambitious growth in their portfolio.
Absolutely.
So you've seen that as well?
I am seeing that, and it is a natural growth progression in the portfolio, right? So initially, and the traditional approach is that you start buying in your own name, and then you branch out to trusts, and then to more sophisticated structures beyond that. And the reason why that journey is taken is because no one's actually got the full vision of the portfolio in the beginning, right? We say, let's try one and see what happens, right? But if you've already got a vision, you may have to switch that around and start with sophistication and then go to individual borrowing to really accelerate your borrowing power. But it does come at a cost, right? So this is where the balancing comes in, where like we started, we had all of our properties in our personal names, even though we were in the medical profession back then and had a higher risk of being sued. Because my accountant back then gave a really good piece of advice saying that people are after the equity in your property. So if you mortgaged it to the hilt, they're not able to get to the equity, right? And that's as simple as it gets. Take away all the fluff, right? And then the problem does come in when you've paid them off, which is what we're going through at the moment. We're getting some really, really good advice as to how to restructure the portfolio, cop some capital gains or restructuring cost on the chin to make the portfolio a whole lot more efficient to pass down to the next generation.
And this is when, you need to get different advice depending on where you are. And it's probably not going to stop you. You'd probably be investing in property to the day you die, Victor, I would imagine.
Yeah. I'm a property addict, not an advisor.
You're a property addict, no. which is good. But what you do is just going to be different, right? And that's okay. But to the point of how finance can be enabler or inhibitor and its impact on your portfolio, what you're doing today won't necessarily be what you're doing sort of in the future. And you're better off not unraveling mistakes. So would be my view, and that means getting the right advice at the front end. And often it's hard if you're buying your first investment property to think big. If you don't have a lot of experience with property, fortunately from the very first property I've bought, I've always bought in structures, which is going to give me a lot of choice into the future. However, that's had additional costs connected with it, but I've paid it forward in many ways. So trying to unravel things hasn't really been largely an issue. It's given me sort of a structure which will give me longevity and continuity moving forward. However, a lot of other people may do it differently. So you can fix issues, you can fix mistakes.
It does come at a cost.
And it might not be a mistake today. It might only rear its head as a mistake in a decade's time or 2 decades' time, but it does come at a cost. And one of them would be cross-collateralisation. You must see this, and no doubt you'll tell me it's good for the right thing, probably not so good for most things.
Yeah.
Cross-collateralisation, you can use that as a good tool if you haven't got enough money to get going. You could use that. It's a good tool to get started, but you very soon have to separate the two properties so that you're not risking the whole lot to one bank. We were talking about that in the car,
So one of the things that where our portfolio is right now, we have a portion of our portfolio cross-securitized because that's the only way the bank was going to release massive amount of money back to us, as opposed to having them piecemeal with different lenders, which have taken far longer. And we had a very clear plan to retire the debt. So we are very comfortable with cross-securitizing. I think it's about 12, 15 properties under the one loan banner,
which is where my problem is.
Trying to work out what's what.
Actually, so that the flow on was, right? So we got the money, right? But then the flow on was, we created ourselves an absolute admin nightmare, not only from a record keeping point of view as well, but from a taxation point of view as well, right? True. So, how do you apportion the money? Because I'm continually drawing down constructing and all this sort of stuff, right? So, by and large, the standard rule is you should not cross-securitize or cross-collateralized, but there are always exceptions to every rule.
Yeah, and again, depending where you are in your journey, will probably degree of the sophistication you have. And no doubt what you choose to cross-securitize, you need to be super strategic with it as well, because I assume these properties you're going to keep and probably pay the debt down at some point in time rather than properties that you want to transact isn't necessarily good to have it in a cross-securitized structure because you can't individually transact them.
No. It works. It works in a upward mobile market, right? Cross-securitization doesn't cause many issues, but when the market trends downwards, let's say you wanted to offload one property, right? So you've offloaded the property, then the bank will say, okay, I want to now revalue the entire portfolio because they're all cross-securitized, right? And then it may be that the profits that you had from this one sale needs to be put back into the loan to keep the LVR where the bank had approved, right? So that's one of the biggest things that you have. And then also, if you haven't planned properly and you hit dire straits and you just start running behind on mortgages, the automatic default rate is 2% above your current interest rate.
Yeah, okay.
So that means the whole loan across the whole, in our case, say the 15 properties, everything jumps by 2%. So you're already in trouble, and now you have to pay 2% more across all of your mortgages.
And you can't liquidate one of them because they're all sort of connected together.
Yeah. So you have to revalue everything to be able to prove to the bank that the LVR is the
Does
same.
your mortgage broker like you? You must be. There comes a point like where I'd say I'm probably quite a challenging proposition.
I actually have to pay for the privilege of a broker to work on my file because it does take them that long. Yeah, because there's so much paperwork, understanding all the different entities and different income streams, and the rents keep moving because I've just during the assessment phase I've already moved one rent, so it is hard work, right? And that's true for any portfolio that's large or larger, and a good broker that's worth their salt, you need to keep happy. Yeah.
Got to keep them happy because, it can be, look, I'm sure refinancing 15 loans probably not a bad deal for a broker, but, but you need that advisor. Who should you be turning to for advice on stuff like cross-collateralization? Is that your mortgage broker? It's more of an accounting thing? Or
it's
quite strategic.
It is strategic, right? And I think it needs to be a rounded advice between your property strategy advisor and your accountant and your broker. Because you really need to look at, okay, we're getting into this scenario, how are we going to get out? And bottom line is that if the only way the bank's going to give you the money is by cross-securitizing, that's how you do it.
That's it. Yeah. If you want to keep going and doing stuff, or you can just sit in the sidelines and wait for something else to take place, right?
Mm-hmm. It's right in the beginning, I guess, when people start investing, and then this is when we talked about they're going back to the same bank. They are not realizing that most of the time that is exactly what's happening. And they're getting the loan, but it's cross-securitized.
Yeah. They just sign the paperwork and they don't get that doesn't explain. What I see also is that, in sort of common decisions that people get wrong is, they think they owe a sense of loyalty to a bank because the bank has lent them money in the years, or the family's always banked with them. Often you compromise by that loyalty because banks. Yeah, you think if you stick around with the bank longer, they're going to give you sharper rates. Normally, it's the opposite. Normally, it's the opposite. You've actually got to go somewhere else to get better pricing because they just go, well, they're not asking for a discount and we don't need to give it to them.
The same product with the new customers, you'd find advertised for much lower rate.
Yeah. And you call them up saying, I want that rate. And they go, no, it's only available for new to bank customers. Go, I've banked with you for 20 years. Well, you're not going to give me that. So there's no loyalty in banking.
No. And they're there to make money.
They're there to make money, to live with the shareholders, right?
You have to be smart enough to do the right thing for yourself to make money.
Yeah, don't be loyalty. Look, banks are cool. I'm not beating up banks. I like banks. They're very fortunate to say we have a very strong banking system and it's diverse. From your major banks to your mid-tier banks to your non-bank lenders. So they all do a really, really good job, but just don't assume loyalty to your bank. Probably the biggest mistake I see property investors make, not knowing their interest rate. You run a mortgage broking company, Victor Investify. It's nearly impossible to actually know what your client's current interest rate is these days, right? You've got to work really, really hard. The banks make it difficult for mortgage brokers to actually know. Like my broker doesn't call me up and go, Phil, I know your rate's this at the moment. Like the only way they can find it out is to go and speak to the bank. There's I know, I can go to my internet banking and work out what it is. But most investors, I think a lot of investors do, maybe a lot of people without and occupier home loans don't even know what their interest rate is.
No, and that's true, right? So a lot of people, when I'm talking to them, they have to double check while I'm in the meeting with them to look at their rates to see what they're at the moment, right? Because you assume, right? Yeah. And especially, the hardest thing when you're building a portfolio is that if it's not causing too much pain in your finances, you sort of become complacent and let it roll.
Yeah, it's horrible, and complacency is the.
That was directed at you.
Absolutely, complacency is complacency is probably the biggest mistake that property investors make inside of their finance. And I sort of go in there. It's often you go, it's only a couple of basis points. Does it really matter? Like when it hurts, it hurts. When it doesn't hurt, you don't really notice it. So even if the wind is behind you, you should make sure that you're never paying a cent more in interest than you should do. How do you find it sort of at a tactical level buying property? Is it always, if you're buying with cash, does it open up new markets for you? Do you think, are you ever sort of stifled sort of investing in property if you are using debt?
Yeah, so if you're using cash, you can buy properties that the bank may not be comfortable lending money on in its current state, right? So let's say someone started a renovation and they've gutted the bathroom and the kitchen, right? Yeah. So one of the standard tick boxes on a loan evaluation is, does it have a functional kitchen? Does it have a functional bathroom? The thought process being that you're going to go bad the minute you settle, and the bank needs to turn around and sell the property. So if it doesn't have a functional bathroom and functional kitchen, they need to de-risk it. So they may lend significantly lower loan-to-value ratio, or they may turn around and say, this is not within our appetite. Yeah. But if you've got a wad of cash, you could buy that property cash, fix the problem, then find a lender that will actually allow you that cash out back. And this is where a good accountant does come into play as well, where you're structuring the purchase well enough so that you can actually extract the money back out immediately after you fix the problem. Yeah, that's one of the things we've done really successfully in our portfolio.
Yeah, extracting the money out. So you have to actually go to you have to select the lender which will allow that, and that's not
the
all
job
lenders.
of the broker.
Yeah.
Yeah, and often even if you do some work on something, lenders don't like to refinance stuff very quickly.
No.
Which don't like. But I remember early days of the Smart Property Investment Portfolio, Right Property Group helped us, secured a property for us out in Cambridge Park.
Cambridge Park, yeah.
And I remember we bought it at auction just before Christmas, I believe, maybe a couple of days before Chrissy. It was us and one other person bidding on it, and the other person just pushed it up. I think it went to $236,000, right, for a 4-bedroom property in Cambridge Park. When it got to the point of getting the loan settled, the bank said, "No, we're only going to value the land value of it, because they thought that wasn't habitable, which you could have lived in it, right? But you guys saw the opportunity in it, and you went, well, okay, well, you're going to have to find another, 20-something grand, which wasn't a problem. It's a lot of money. But it's just 12 years ago. But
money is found in problem properties where we can find the solution for the problem very cost effectively.
Do places like that still exist today?
They do.
Yeah?
They do.
Yeah.
They do.
Really? Can you find
That's
some?
why you just keep wanting to keep
See, every
buying.
time we come here, he keeps asking for stuff. Right?
Can you find What about sort of finance clauses in contracts? Do you always load them into it, sort of make it all conditional around finances?
Depends on the state, right? Especially in today's market where a good property is highly competitive.
Yeah.
Right? You try and make it as attractive to the vendor as possible. So if you've got finance down pat, right, you know that you're going to get finance. You've got pre-approval. You never go in without a pre-approval. You could have a shorter finance clause, or you could get rid of it altogether if you've got enough money behind you. If the bank turns around and says, no, I'm not going to do a Cambridge Park on you, then you can settle bulk of it in cash. Then it's safe to do that.
Okay. Yeah. And again, this gets super tactical.
Yeah. So with most of our clients, we never put them in a situation where there's no finance clause unless they've got the equivalent of the property purchase price available in cash.
Okay. And when you think of the sort of sequence of where finance fits within everything, and when someone sits down with yourself or your team at Right Property Group, you're going to want to know that people have finance. They've thought about finance or down a pathway of having finance. That needs to happen first sequentially, right?
That's right. Yeah, because unless you know how much fuel you've got in the tank, how are you going to map out the journey?
So the thing is, sometimes I feel like people are a little bit hesitant in letting us know right in the beginning, because remember, we've got the two ladies out the front facing the clients when they come through. They need to know a lot about them in order to do more, in order to get to a meeting with Victor, is even like in getting to work out their goal. People are a little bit hesitant. They don't want to tell. And that is actually not working in their own favor. So, and sometimes they don't know much about their own selves because they may have subscriptions or money going out which they have not accounted for. So they're, a lot of the times people are not really aware of their financial status in that sense, their budget, the income, the expenses mostly, the hidden expenses are there. So it starts right from the beginning. If you have your baseline, if you're really aware of where you stand, that's the key. Like you really need to know that, and then when you know what you've got right now and where you want to be, then we can map out the pathway to get there.
Yeah, and a lot of times people turn around and say, no, I've talked to my bank and they said I can comfortably borrow $1 million, right? But there's many a slip between the cup and the lip, right? So you need to actually put your application in, get them to assess it on the paperwork that you've provided to determine how much they can actually lend you, right? Because like I said, it's the fuel for the journey. And then for us to then map out the journey itself, we need to know what we're playing with. And then the next important bit is the interest rate, right? If the interest rate's too high, let's say the bank's saying, I'm going to give you, $1 million, but it's at 10%. You've got to think long and hard. Is it worthwhile?
Yeah. And again, if you don't know what you're looking for, you're not going to know what's presented to you is right or wrong. And in order to get the biggest bang for your buck from your property strategist buyer's agent, you've got to essentially strip yourself naked. Like, no use hiding stuff.
Yeah.
Like, tell them, show them exactly what's going on, and they might go, well, you've got some things to fix here before we can do anything. That's fine. It's part of the journey. It's part of the pathway.
Well, if let's say you're going to a doctor, you've got to tell all your symptoms, right? Yeah, to get the diagnosis. Exactly the same over here.
Yeah. Cool. All right. Well, finance is important.
It is very important.
Yeah. I know you guys do a lot of financing stuff, but on the how you going? You must be sort of up to your eyeball chatting with clients at the moment. How hard is it to get in Victor's calendar, Reshmi?
I think it's very hard. I was actually thinking.
So the point would be prepared, but it must be pretty tough.
Yeah.
The people that are more prepared, they get priority. So there is a definite process. So when you make your initial inquiry, you're either chatting with Melissa or Kate, both who are very seasoned investors, personally trained by me. And then they...
Kate's been around for ages. Kate helped us on our first purchase through Right Property.
I know, yeah. She has been Reshmi's discovery from our doctor's surgery.
Doctor's surgery.
Yeah, she stole her from our doctor's surgery.
Yeah, she's exceptional.
I still talk to the doctor. I used to work with him before.
Okay.
So, we're still in talking terms. But yeah, she's been around for quite a while. So the idea is that they will then do all the fact finding. So that by the time they're talking to me, we're talking strategy. We're not talking, how much do you earn, all this sort of stuff.
Yeah.
Right. So we're actually ready to start implementing.
So you go, I've got all this. So essentially, you're like the doctor. You get this report that says everything. You go, okay, I've got all the facts, and let's work out what we're going to do.
Yep.
Sounds efficient.
Sounds efficient. Yeah,
Sounds
it
very,
is
very
efficient.
So it's action time when we come to meet Victor. It's action time, and all the pre-work is done in the beginning.
Yeah.
So that's where it's important when people don't want to share information. It's crucial. You have to share your information.
You've got to share the information, and they're going to help you as well, right?
Yeah.
You go, fix this. Go and speak to a mortgage broker. We'll see you again in a year's time, 18 months' time, 2 years' time.
Yeah.
And our record is 7 years. I spoke to, I won't mention his name, but he's He was fairly young back then, and spoke to him 7 years ago and told him to do a whole lot of stuff, including reading a few books. And he came back 7 years later, bought 3 properties for his portfolio.
There you go.
And he did the hard yards, right? Wasn't on a big income, but it's just being methodical in the approach that gives you the fruits.
There's a sequence to this. So how do people track down? What's the best way to chat with Kate and Co?
So you can go to the website. There's a contact me form. They can book directly into their diaries as well. And failing that, just send us a private message and we'll respond on our Facebook page.
There you go. Yeah, these guys are pretty responsive. I've known her for years. Known her for years and years. It's Reshmi and Victor Kumar from the Right Property Group. This is Property Investing Insights, the Right Property Group. Hope you enjoyed it. Any ideas of anything we can chat about? We're happy for feedback. Questions at rightpropertygroup.com.au. Send it through. Any comments, any commentary, anything you like us to do less of. Happy for the feedback. We're happy just to do Q&As as well. So send them through and we'll get them answered. Remember to check out rightpropertygroup.com.au. It's RIGHT for the right property. It's all in the clues are in the name. Thanks for tuning in. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.